Good evening, everybody. Welcome back. The markets are moving. There's a lot of volatility around, so we need to sort of look at what's driving all of this. And to be honest, inflation sits at the core of most of what we're looking at with the financial markets at the moment. We've got these hopes and fears of early 23. We started off with a certain amount of positivity, as you all saw. We saw that good stock market rally. There was a risk positive sentiment floating around. We saw stock markets led by supply strength in the global economy, despite aggressive catch-up rates from central banks. Unfortunately, what we saw in February, stock traders were focused more, dominated by negativity created by news that the recent downtrend for inflation was stalling. Now, Euro area core inflation hit a record high. Now, remember, it's the core inflation that the central banks look closest at. This is the inflation with food and energy, which is extremely volatile, taking out. However, that still impacts us who go and buy stuff. So it does matter, although the Fed doesn't really take so much notice of it, or the ECB. But this is rather worrying. Advance in US consumer prices points to persistent inflation, the chart on the right here. This is concerning, and this consumer inflation has actually seen quite a stark turnaround. Are the economies hotter than we thought they were? Has the impact that the central banks have put through with persistent rate hikes actually done enough? There is a lag with monetary policy before it hits the real economy. Has that come through yet? We don't know. So there's a lot of risks involved at the moment. So if we look at the USA 500, what we call the S&P, the daily chart since January the 2nd, you can see the sort of ebb and flow of this market, starting off with this positivity at the start of the year, got up to the 1st of Feb around 4,200. Bit of a level that now, something to bear in mind. We saw this negativity drift into February. And I think, what we've seen now is a little bit of a disappointment. We've had a couple of potential rallies just recently. But again, into this week, we've seen more negativity again, and the stock market falling, the S&P falling below 4,000. So what about March? This is getting really quite serious. The inflation has not gone away. The central bank reaction to that has slightly surprised markets. And I think although we knew they were sort of quite hawkish, in March, we've seen a repricing of interest rates and interest rate expectations. So where is the peak rate going to be? So March has been dominated by this repricing. And, we've seen the Fed expectations for the peak moving from 5% early February to 5.5% to 5.75% in March. So, this is quite a big shift. And we know that sort of short term and any rate yield rises is not good for growth stocks like tech. And we've seen these big swings from one direction to another at the start of the year. As you can see on the chart on the right here, they're pretty big swings, and they're still going, by the way. And also we've seen short-term rates reaching multi-year highs, as you can see on the chart bottom left. But also within this, we've seen quite a steep inversion of the curves again. So the short end rates yields are much higher than the 10-year and the 30-year rates, which suggests that there's fears looking forward that the US economy could be falling into recession. Now, these are at record levels now, and that is something you need to read up on. We don't know how clear a signal that is, but historically, it has been a precursor for steep slowdowns, if not recessions. So we need to bear that in mind going forward, because this is obviously an ongoing risk for not only valuations, but earnings, and therefore stock markets altogether. So this, what we've got here, this repricing has brought an alternative to equity earnings. So if we look at S&P earnings, for instance, they sort of earn around 5.6%. We've got 6-month bond yields and 1-year bond yields at about 5.25% already. Now, that is far safer risk than equity risk. And so now this idea that there is no alternatives to stocks is over, really. And so now a lot of these big asset managers are looking to rebalance their portfolios, having a greater interest again in bonds and their returns than maybe equity markets. And so this is another headwind for stocks going forwards. So I think while stocks have seen This has seen stocks in the US and Europe wobble. They have been quite resilient. The VIX, the fear index, is still below 20 or hovering around that level now, which is quite surprising. So is the market short stocks already? I think to some degree they could be. So, positioning got quite negative into the early part of this month, and I think also into the back end of last year. And I think what we're seeing is the reason why we're not seeing volatility spike in stocks. We're seeing a pretty orderly move down considering what we're seeing going on in rates. I think maybe the market has been caught a little bit short. Whether they're out of that now on these rises, it's going to be difficult because to understand, because inflation is remaining what we call sticky. So it's failing to go away. There's chatter that the supply chains are being fixed, but this isn't just a supply issue. Rents are high. Used car prices in the US are going back up again. These things feed into CPI data, and they're big components of CPI data as well. But, Fed Chairman Powell shook the markets on yesterday when he was expected to be hawkish, but was more hawkish than I expected and most of the market expected. Not only talking about higher rates than many people expected, but possibly increasing the pace of those hikes as well. Now, that is key to a lot of the stresses and strains we saw yesterday and feeding into the markets again today. And you can see here the US Tech 100 chart showing some weakness. It's coming off again from those highs. It's beginning to roll over. The German DAX also coming off almost all-time highs here, but starting to sort of show some vulnerability. I'm surprised these aren't a little lower because of what we're seeing going on with yields. But again, maybe the short-term market is a little bit short. But I think, better economic data from China has given some hope that stocks can ride this out and that China will ride to the rescue of the developed world. I'm not sure about that. It's early days. Data is improving from China. But if we look at commodities and oil, they're all rather low. So this demand hasn't really come through yet. So I'm still worried a little bit about the vulnerability of stocks. So then we need to sort of have a look forward here. And the natural inclination for equity investors with 12, 13, 14 years of just buying the dip and, the Fed will come to their rescue if things get really bad and slash rates. I'm not sure that's the case anymore. We've got quite strong data. US service providers have expanded more than forecast. This services sector is very strong. And this actually faces the consumer. So that shows there's still a lot of resilience in the US consumer. US stocks have bounced off some technical supports a few times, giving hope to the dip buyers that this can, hold pretty well on a structural basis. And some of the stocks do look fairly well supported on the charts. The problem is the fundamentals are looking a little bit weaker, if you like. Earnings were not good. We've got higher interest rates coming. It looks like we've got a Fed determined to push the economy into some kind of stress to cleanse the economy from inflation. So this short-term technical support may not help. China rebounding strongly could, but when? And in the meantime, we've got a very hawkish set of central bankers, not only Powell and the Fed, but also Lagarde and the ECB, very hawkish at the moment. So could the impact of rate hikes on businesses push equities even further down? Yes, I do. I think those margins could be compressed. Now, we've got payrolls coming up as well. So non-farm payrolls is out on Friday. We got weekly claims tomorrow. We had ADP, which is the private sector employment data today, which also was strong. If these data come in strong again at the end of this week, we're going to see higher bond yields and more stress on places like the USA 30 Wall Street here. You can see the chart there. That dip that we've seen is quite aggressive. These markets are not going to like stronger data. So we are very data dependent at the moment. Now, Friday at 1:30 GMT, we get expectations for non-farm payrolls. The headline, 225,000 jobs expected. The headline is extraordinarily volatile, so be careful with this. But watch the unemployment rate. And the other thing to watch is average hourly earnings. So the unemployment rate is at 53-year lows. If it stays there or anywhere near that 0.1, 0.2, the market's going to suggest that the tight labor market is still with us. If we start to see big jumps in that, then the market may start to price the Fed out of hiking anymore. So average hourly earnings are still rising. Now that is inflationary as well. So this is pivotal for the direction of stocks, make no doubt about it. This is an important week. We've heard from Powell. We've got some tier one data. Volatility is just about assured. So it's not going to be easy trading into the end of this week. But, you know, not only is this pivotal for the direction of stocks, but just about every other market as well, the dollar, commodities and everything. So expectations are leaning to another strong print. As far as I can see, because the feeders into this have been quite strong, but it's very difficult to read because the Bureau of Labor Statistics applies some pretty unusual seasonal adjustments to it. It's difficult to get a true handle. So don't worry too much about the headline. Look at the fundamentals, the unemployment rate and the average hourly earnings. They're the ones that the Fed's going to be looking at. They're the ones the market's going to be looking at. But I can probably assure you that it's going to be a pretty tricky end to the week. So be careful out there.